Lewis mainly sells goods on credit through the Lewis Best Electric and My Home brands.
Yeah, if you've travelled the length and breadth of South Africa, you've no doubt seen those Lewis stores. Plus, they bought a few stores out of the liquidated African Bank Ellerines group. They're having a bit of a tough time lately, though.
Market cap 4.1 billion rand, PE of 6.7 and a dividend yield here of 12.3%. Tough time being the relevant discussion point here.
Very much so. They've unfortunately run into a lot of regulatory problems, and it really is around that credit side of their business. Some of it is self-imposed, which they've mea culpa'd and said, yes, we did sell insurance, unemployment insurance to self-employed and people and pensioners. And that really has put a drag. And the National Credit Regulator has ruled against them. It came out yesterday, I think late yesterday or today. So this is really overshadowing it. And this is, you can see it in the valuation of the share. I mean, a massive dividend yield. Let's get that
share price graph. On that note, let's get the share price graph. And there it is, as clear as daylight.
Yeah. So its performance, unfortunately, hasn't been good. It's really a cheap share. It would be that definition of the Benjamin Graham cigar.
The value share of the future. I mean, the value share of today to yield value tomorrow.
Yeah, correct. And so if you believe it's sustainable, you can pick up a 12% dividend yield, which is incredible. But the credit space has become really, really difficult.
That's to do with how much extra information you have to show that you've obtained from the potential borrower.
So the National Credit Act has almost ramped, and the regulator have ramped up the ante in terms of this so-called affordability assessment. And it really is putting a lot of pressure on credit retailers. So I think the model that they've got has to change. That's my concern, is their business model is fundamentally got to alter. And I'm not sure they're keeping up with that.
So even on the value metric, you wouldn't say that this one is hot?
No, because I don't know if it's sustainable. That was the point I was making, is they have to change their model.
The dividend yield in particular.
Yeah, the earnings and thus the dividend yield.
Yeah, it's a well-run business, historically quite kind of cautious in its methodologies, but it is unfortunately been hammered by the NCR, and I would share Lance's views that it's too soon. Its competitor JD Group, which is part of Sign-Off, is also changing its business model a lot. So, and then consumer demand's a bit depressed.
So do we have agreement?
Not hot on this one.
The first stop that we've got consensus, and you didn't even huddle at the break.